Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio. In our Tuesday special today, we try and simplify two different subjects for our viewers. First up, with Shweta Rajni of Anand Rathi Wealth, we discuss all about investing in gold, the approach post the import duty cut, the view amid geopolitical tensions, and also the most debated, equities versus gold. Where should you invest? On the other side of the break, we'll discuss and make our viewers understand about the tax benefits to retail mutual funds in Gift City for NRIs and foreigners with Kothari of DSP Asset Management Managers. So, power pack show. Let's start again with Shweta now. Thank you so much, Shweta, for joining us today. And there have been so many changes in the budget session, right? So, let's discuss that first. How does the recent budget amendment impact gold ETFs and gold funds? And how does a gold ETF differ from gold fund after this change?
Sure. So, what I'll do is I'll start with explaining the difference between a gold ETF and a gold fund. When you're buying a gold ETF, you're buying it at that current gold rate. It, in effect, means that, you're buying one transaction is 1 unit of 24 karat gold being purchased. Whereas in a gold fund, it's again investing into a gold ETF. So it's kind of a fund of buying an ETF. Gold ETF from a cost perspective is more efficient than a gold fund. ETF means you can exit any time. In a gold fund, generally you have an exit load. Coming to the tax, which has basically changed. Earlier, from 1st April 23 onwards, if you invested in a gold ETF or a gold fund, it meant irrespective of the holding period, you would be taxed at your slab rate. Post the budget changes, if you have invested into a gold ETF and your holding period is more than 12 months, it will be categorized as long term and will be taxed to you at 12.5%. Whereas in a gold fund, if you hold it for 2 years, then it will be considered as long term and taxed to you at 12.5%. Anything below that is short term and taxed at the slab rate. So actually, post the budget changes, gold ETF becomes more tax efficient as compared to a gold fund. However, if you're looking at flexibility in terms of, wanting to do SIP investments or a few other things, then you have to choose. But from a tax perspective, ETF is better than a fund.
Okay, so let's talk about all of these asset classes together. What do you prefer? Sovereign gold bonds, gold ETFs or gold funds? Can you explain what works for each category? And if someone has to pick one, which one would that be?
So, my vote, irrespective of which category you are as an investor, would be towards a sovereign gold bond fund. And the reason I say that, one is in a sovereign gold bond fund from a tax standpoint, if you hold it on till that 8-year maturity period, and then on the maturity, the capital gains are tax-free for you. Second benefit of a sovereign gold bond fund is that apart from the gold price movement, you also benefit from a 2.5% of interest payment coming to you every year, which is taxed to you at your slab rate. So one, it gives you not just gold returns tax-free, it also gives you an additional return. However, the downside is it's not liquid, so you'll have to hold it on, in most cases, till the 8-year period. So if you have that time horizon, I would vote for going in for an SGB.
Okay, all right. So sovereign gold bonds still, after whatever changes have come, continue to remain the top pick when it comes to investing in gold via different ways. What about physical gold, Shweta? The import duty cut, but that has reduced the final price for those who invested some time back. So it has happened with sovereign gold bonds as well. But how do you look at this particular way of buying gold or investing in gold?
See, investing in physical gold does not make sense because, you'll have storage costs attached to it. Plus, there are other disadvantages, I would say, in the form of liquidability, you having to go and sell it in the market. So physical gold, I would say no. Also, import duty cut is just one of the factors that affect the gold price. A major impact towards the gold price comes in from what is the international price of the gold as well as your exchange rate. That tends to have a higher implication on the gold than the custom duty cut. So therefore, if you're looking from that perspective, I would say go in for a SGB than even a physical gold.
Okay, all right. So physical gold is not something that you would prefer so much against the other options. But say between a silver ETF and a gold ETF, which one do you think is more popular? Which one would possibly give better returns to an investor?
So, silver ETF also in the last few years has been emerging and there's been enough takers for it. But if I look at in terms of cost efficiency, a gold ETF tends to be more cost efficient than a silver ETF. Second, in terms of liquidity, the liquidity for gold ETF, if you see, is also better than that of a silver ETF. So while being used as hedge against inflation and having an alternate asset class, both would work. But just looking at these two factors, I would still go in for a gold ETF than a silver ETF.
All right, so gold ETF it is. And Shraddha, how much should gold be as a part of your overall portfolio?
So, I'll just take a minute to explain how gold really performs. So, gold to a large extent is a sentimental asset class as well. And it tends to perform well when there is concerns around, let's say, geopolitical issues or there is concerns around inflation. So if you specifically, take periods like, let's say, the COVID period where equity market corrected significantly. And, if I just see there was almost a 38% correction, which happened from the peak to the trough. Gold at that time gave you positive 7-8% return. Or, times like Russia, Ukraine, which happened, where again equity markets were correcting, gold ended up giving you a 3-4% positive return. But this is only specific periods. If you look at longer term cycles of gold, they tend to give you returns which would be lower than equity but 1-2% higher than that of gold. So if I'm looking at a 10-year period, for example, debt would have given you 7%, gold would have given you around 9.5%, equity would have given you around 12%. Coming to the risk, debt, of course, if this is government paper, it's risk free. The standard deviation of gold works out as around, somewhere 9% for a 10-year period, and that of equity works around as 12%. So therefore, if you have a complete equity debt portfolio, that is also just fine to have. But if you want to infuse gold, then to my mind, it should not be more than a 5% allocation of your entire portfolio. So, let's say if you are a long-term investor, you're looking at 15-year time horizon or 10-year time horizon, I would say 70 to 75% of your money can be towards equity. 5% odd can be towards let's say gold, and 20 odd percent can be towards debt instruments that you have.
All right, so that's the ideal portfolio that you can look at in case you want to split it between debt, equity and gold. Shweta, always a pleasure speaking with you. Thank you so much for joining us today. It's a big development that took place, so always good to get in some expert advice on what's happening with gold, ETFs, funds and sovereign gold bonds. With that, we'll take a quick break. On the other side, we'll be joined by Jay Kothari of DSP Asset Managers. We'll discuss about the tax benefits to retail mutual funds in GIFT City for NRIs and foreigners and try and understand what really went by in the budget this time. Stay tuned for that conversation. Welcome back. You're still tuned into MF Corner. Let's talk about the second important topic that we are going to discuss. This is the tax changes with respect to Gift City that came by in the budget, which would impact retail mutual funds and NRIs and foreigners as well. To discuss this in greater detail and to understand the changes, we are now joined by Jay Kothari of DSP Asset Managers. Jay, good afternoon. Thank you so much for joining us today. Let's stick to the basics first up. What are some of the changes announced by the budget when it comes to Gift City, and who does this impact?
Sure. Thanks for the opportunity, Sonal. Great to be here. So as far as the gift announcements in the budget were certainly, first of all, in the right direction. Number two, this also shows the government's commitment in terms of creating the world-class financial hub to attract global capital. And the changes, what we kind of witnessed were, number one, and in no particular order, but number one, abolition of the angel tax. So, this kind of gives an overall boost to the overall startup ecosystem in India. Secondly, even in terms of the indirectly kind of boosting the funding of the startups via gift. Number two is in terms of the lower compliance for the venture capital funds or the VCs, as we call it. So this is, just in terms of removing the so-called hurdles which they had in terms of the sources of funds. So that's not required anymore. So that kind of eases some pressure from their perspective. Number three, and a very interesting one from a VCC structure, which is a globally recognized vehicle in terms of variable capital company, which a lot of kind of family offices and other institutions kind of set up in Singapore, which we've kind of heard a lot. So that becomes a natural progression where one can kind of set up that structure in the gift ecosystem. But however, there are a few nuances in terms of the number of tax holidays. So in gift, it's kind of limited. In Singapore, it's kind of for perpetuity or forever kind of a scenario. So that's something which is going to be an interesting opportunity. Other part is on the financial leasing, again, not related to the MFs or investments in particular, but when you're leasing aircrafts, ships, etc. So that's going to be a direct competition to Singapore, Lux, or Luxembourg, or Mauritius. So that's an opportunity from an India structural standpoint. And lastly, from a tax exemption standpoint, it's going to be both on a retail schemes and the exchange traded funds, and both retail schemes are now in parity with the AIF. So any foreigner or NRIs investing into India, they don't have to pay tax, if they invest through the retail funds or through feeders directly coming into India. So that's going to be a definitely welcome move. And I certainly see a lot of money coming into India going forward.
Okay, so let's take the last point forward. I wanted to understand, would it impact only NRIs and foreigners, or does it help Indian investors as well here? How would the last change that has come about impact?
No, we wish it was even for domestic, but that's clearly not the case. I mean, from a LTCG and STCG, it's very clear that the mutual fund investors in India, when we file taxes, we will continue to pay these taxes. This is more an advantage to the NRIs and foreigners who even come through the feeder structure. Even there's a segregation. So it's not that every investment structure in GIFT will be getting a benefit. The funds which are set up will continue to pay the LTCG and STCG as applicable, but the feeder structures, which you drop a sleeve in the Gift City, which invests directly into the mutual funds in India, whether it's DSP or whichever mutual funds it invests into, that's a pass-through. So that there you do not pay taxes. So that's going to be a benefit. But for investors in India, it's status quo. The only benefit is that if you want to kind of just take it with a positive bent, is that once a lot of money kind of flows or continues to flow into India, that's going to be good from a flow perspective from an Indian investor standpoint.
Okay, all right. So that makes sense. And thank you for explaining that in such great detail. But do tell us, how does it impact AMCs? Do all the AMCs have the license to operate funds in Gift City? If not, which are the ones that do have it currently?
No, so no, not everyone has it, and it's not natural that everyone has to have it. So it's a choice like any other aspect. So DSP for one, we are one of the largest kind of gift operations. With having almost $600 million we manage out of there already. We have to take a fund management entity license within the GIFT IFSC for operating under GIFT. So to answer your question, no, not all AMCs have it, but gradually I won't be surprised if most of them have it, because there is an inherent opportunity for money coming into India and it's ease of operation. So, initially, if you go back 10 years, 15 years, a lot of investment management entities were set up in Singapore and otherwise because Indian mutual funds or managers were not allowed to invest money sitting here in India. But now you can have a fund management entity in GIFT. So it's not very far away. It's just kind of, 3-4 hours from here. So that makes it conducive. But yes, going forward, I do expect a lot of asset managers to set up shop within the GIFT entity.
That was going to be my next question. If we'll see more retail funds, ETFs being launched now in GIFT City because of this change. Are there any right now? What is just the expectation after this change that has come about?
Yeah, no, so it's a very valid question. So I think the only difference why you didn't see any retail funds getting launched, and it was mainly the AIFs, including us. We've launched mostly the AIF strategies, but incrementally after the clarification in the budget where retail will also be classified under the same kind of tax regime as AIF, this will encourage a lot of people to now start going with more retail strategies. We have done that as well. So over the next few months, you'll see a lot of retail funds being launched within the GIFT structure.
Okay, all right. Jay, last question before we let you go. We've been seeing a lot of changes already. RBI raising that limit that had come by here. Now, an Indian investor can open an offshore account there if they have payments abroad. Is there any other change that investors should be aware of from a GIFT City perspective that could benefit the Indian investors as well? Of course, the NRIs and foreigners, something that you explained right now.
No, absolutely. I think it's from a direct impact standpoint, the way we need to look at it is that India is still not an obvious in terms of the global allocation from funds or investors, whether it's hedge funds, family offices, sovereign wealth funds, pension funds. So I think when they look at India, now the question is from why India to how India. So how do you access India? So this becomes an obvious kind of answer in terms of GIFT is another opportunity. So Mauritius and Singapore were other opportunities, but now with the proactive regulation, I think there is another option, and through this, a lot of money will come in. And I think from our perspective, what we need to understand is that global funds are still underweight on India. So if we see over the next 5 to 7 years, even if $25-30 billion per year can come in through the FPIs, it is going to be a function of how easy we are making it for global investors to invest into India. And with all these proactive steps, I don't see any reason why foreign investments should continue to flow, even after a lull, which we've seen over the past couple of months, where retail or domestic institutions have kind of outpaced foreign flows. So I think I remain very hopeful in terms of foreign flows entering in India.
Okay, all right. Take that point, Jay. Thank you so much for joining us today with your take and to explain the changes that we've seen in the recent budget when it comes to GIFT City. Hope to be speaking to you very soon again.
Right. Thank you.
Okay, all right. That's all we have on the show today. But stay tuned for Closing Bell to take you through the last hour of trade.